We take a look at how investment markets have done over the last financial year. Looking back on the last 12 months, it's been a pretty good year for share markets on average, but it was really a year of two halves. International shares returned 9% in local currency terms and over 15% in Australian dollars. The strongest contribution came from US shares, with investors being richly rewarded due to strong underlying economic growth driving earnings and a big boost from tax cuts this year. Almost all of the returns for global shares came in the first 6 months though. Since February, we've seen volatility return, caused by inflation fears and now trade wars. Locally, Australian shares also had a good year, returning 13.2%. The index return was driven by very strong performance from the resources sector, riding high on commodity prices and record export volumes. The financial sector really struggled though, as banks grappled with slowing credit growth and a succession of scandals. A year of low but still positive returns for fixed income, both domestically and globally. Bond yields in the US have continued to rise this year, and in February, Australian bond yields actually fell below the level of US bond yields for the first time in 18 years. We expect that yields will rise gradually over time from here, so these low returns from fixed income assets will probably continue. They should do well though if there's an economic slowdown, so they're worth having in a diversified portfolio. Australian inflation has remained just below the RBA's target range of 2 to 3%, and cash rates are expected to remain on hold here until late 2019. Property overall has had a good year. Listed property trusts returned 13.2% in Australia and 6.4% globally. Institutional investments in unlisted property also did well, but the residential market has had a more difficult time, registering a small drop in prices on a year-on-year basis to May. In the medium term, we expect lower returns on growth assets as the rate of global economic growth slows and asset prices trend back to long-run averages. Income-oriented assets like cash and fixed income will probably continue to deliver low positive returns. Over the longer term though, a diversified portfolio should still deliver solid outcomes. Your planner can help you construct a portfolio with the right strategy and defensive mix to smooth out the ride.